Meta stock is standing right in the eye of the hurricane right now, with a valuation surpassing $1 trillion. And when you look at the chart, the earnings per share keep climbing at a compound rate that almost feels unnatural, suspicious. But things get even more interesting once you compare the revenue to the stock price. Meta's total revenue has doubled over the last 5 years, a clean and healthy increase, just stable growth. But the stock price from 2020 didn't double, it tripled, a 3x explosion against a 2x revenue growth. And that gap raises a real question. Where is the extra value coming from? Most people point to the AI race. Every big company wants to dominate it, Meta included. Therefore, the next step is understanding where Meta's financial strength really comes from. When you look at Meta's total assets, they've increased over the last 5 years, growing in a steady line. So far so good. And the current assets, cash and short-term investments, have been rising sharply during the last 2 years, which sounds like great news. More cash usually means more safety, more power. But here's where the picture begins to twist, because the real explanation behind that cash pile isn't as simple as it looks. Therefore, we need to examine the part nobody wants to talk about. Meta's long-term debt tells the real story. In 2020, it sat around $10 billion, then it increased to roughly 12, then 25, then 35, and now it's about $47 billion in long-term debt. That's not a small bump, that's an explosion. And this sudden rise in debt might be exactly what's feeding their cash position. Borrowing to look stronger, financing instead of growing organically. If this trend continues, Meta's fundamentals could become a ticking problem. Therefore, the next thing to examine is how that debt compares to Meta's assets. This is the most important graph of the entire analysis. Total assets are increasing. Liabilities are increasing too, which is normal. But here's the issue. The debt to assets ratio has been rising sharply, from 8% back in 2016 all the way up to 33% in 2024. This means a large portion of Meta's growth is being held up by liabilities, not revenue, not operating cash, not internal strength. And that type of growth can break down quickly if the company faces a bad year, something Meta already experienced in 2022, with the metaverse losses. But to really understand if this pattern is unusual, we need a comparison with a rival company in the same industry. Google gave us the perfect comparison. Their cash and short-term investments have decreased, which could look like a problem, but their long-term debt hasn't skyrocketed. It hasn't behaved like Meta's. Google is not using debt to fund investments. They're using real operating cash, real earnings, the kind of financial strength that stays stable in the long run. Meta, on the other hand, is leveraging debt to fuel growth. And while Google's debt to assets ratio has increased slightly, it hasn't jumped past 30%. It hasn't exploded the way Meta's did. Google's balance sheet is growing naturally. Meta's growing artificially. Therefore, the final question becomes unavoidable. Is Meta fairly valuated at today's price? This is not a financial advice. Your decisions, your risks. But from my perspective, Meta's price will make sense if the stock were trading around $400. Revenue doubled, assets increased, but the debt is telling a louder story. Meta is using a long-term debt to invest in AI, not internal financial strength. But the bigger question isn't whether Meta is strong, it's how fragile that strength becomes if the industry hits turbulence. Meta is unlikely to fail, but no company is invincible. Every sector has its moment. Tech has it now, but moments eventually end. So tell me, do you own Meta stocks? Do you think this level of debt is a red flag investors should pay attention to? Let me know in the comments. Have a good day, and always keep learning.